Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, November 13th, and this is the weekly market update. The disclaimer, as always, anything that you see or hear on this video or here on the podcast is not to be taken as investment advice. I am not a financial advisor. I do not know your personal circumstances. Therefore, I cannot give you particular individual advice. Please do your own due diligence on any of the ideas that you may hear on here. It's your money and it's your responsibility. Plus, I'm just a guy on the internet. You don't really know me or know what I really know or don't know. So I was going to do a little bit of Q&A. I do get Q&As or questions in from various subscribers to the channel, or also people on my Discord channel. The Discord channel, of course, is a benefit of a subscription to the Actionable Intelligence Alert. I think it's pretty valuable. We have a pretty good group of folks in there, subscribers, people that have different backgrounds, and they're able to share real-time advice. We have a farmer in there. He's talking to us about, some of his input costs and things like that, just as an example. So there's all kinds of good information there, but some of the questions come in from the YouTube channel. And so occasionally I'll address these, but here are some questions from this week. Any thoughts on the current natural gas space? Burgeoning food prices, fertilizer costs, etc., in addition to winter weather. Yes, the whole energy complex, in my view, is going higher just because of the things we've talked about before. Specific to natural gas, the thing that's interesting is, I think that some folks forget about, is that natural gas is hard to store. It's not as easy to store as oil. Oil's liquid. Can be stored in huge tanks. Gas is more difficult. It is stored. It can be stored, but it's more difficult to store and transport. So that comes into play. And the natural gas space is also affected by the lack of investment we've seen. There was overinvestment. The drill baby drill fracking revolution did affect the natural gas space. So there was an oversupply of gas. That's being rectified now also. The investment going into new gas has not been sufficient. And so if you look at the current natural gas supplies, or gas supplies and storage for the US at least, we are near the 5-year low. They have various websites. I'll throw a link up to one I like to use. It's called American Oil Man. They have the natural gas storage, and it shows for like this year and back like 5 years, so you can compare, and you can see that we're well below the 5-year average. What does this mean? Well, because we're forecasting I'm not forecasting, but the people I listen to that are forecasting another La Nina and a various Atlantic oscillation, Pacific oscillation setting up to cause incursions of the jet stream down into North America and Europe. I'm forecasting my view is that we're going to have a colder than normal winter. And when you juxtapose more heating degree days or more demand for heating against a, below average storage, this could lead to a price spike. It's very, we've seen this in the past, not recently, but in the last, 10, 15 years, there's been price spikes in natural gas where we've seen gas go to $10, $12 an MCF. Now in Europe, some places in Europe, places in Asia, you're already seeing gas prices well above that, simply because of the fact that the gas that they're bringing in is LNG, and it's not pipeline gas. The situation in Europe is interesting because Europe has been short-sighted in its energy policies. Its focus on renewable energy and not thinking about gas and fossil fuels. And so they've really tied themselves to Russia and Gazprom. And now whether you want to think that Gazprom and Russia is bending them over, not supplying enough gas to increase the storage in Europe, that's discussion for another day. the fact of the matter remains that there's insufficient gas right now. So you're setting yourself up if you have a bunch of demand come in because of increased or because of increased heating demand days, another price spike. So I think that we have a chance for that working out fairly well for us. Sandridge Energy is a gas, natural gas and liquids producer in the central part of the country. They're pretty much they don't have any hedges on. They just came out with earnings last week. They're just chock full of cash over there. So, there's opportunities out there. It's specific in the portfolio, not really. We're mostly focused on oil and the service stocks, but yes. So burgeoning food crisis. Yes, we have a food crisis because of lockdown policies, because of labor shortages caused by lockdowns. Fertilizer costs are through the roof. Why? Well, your three types of inputs are nitrogen, phosphate, and potash. And natural gas is a key component in the production of nitrogen-based fertilizers. And everything's going through the roof now. Another sector of the economy, fertilizer, that has been ignored, that's been had low prices for a long time. And so now you have a situation where you have increased fertilizer costs. You have countries like Russia and China putting export moratoriums on, and that doesn't help the situation. So yes, the people don't understand we have the inputs of these fertilizers in the large scale, industrial scale agriculture that it allows has allowed the population of the earth to get to where it is, 8 or 9 billion people, whatever it is. And, another thing that fertilizer does is allows more marginal farmland to be brought into productive production. And if you raise prices for fertilizer inputs and you don't see a consummate increase in grain prices, which I don't think will happen. I think grain prices are going to go higher. I think that's going to be the next area in the commodity complex that we see big price movements. But regardless, there's a lot of second and third order thinking that needs to go on here. It's not just, you go down to your local farmer's market or Whole Foods and you got a guy there with a little apron on, smiling at you saying, here's all the produce. You have to understand what it takes to do that. A lot of your salads and stuff like that stuff's produced in California and Florida. I grew up in Southern Florida around Lake Okeechobee. That is the winter vegetable capital of the world. You get 2 crops a year down there. And the soil is so productive because of the hurricane that happened in the 20s. It basically lifted the bottom of the lake up and distributed it all around the communities around there. I mean, it was a big loss of life, and they ended up having a public works job to build a big dike around the lake so it wouldn't happen again. But it basically created this several feet thick of muck that you can just, you don't need to fertilize. And so it's very productive for, all kinds of winter vegetables. And so, the rest of the country, or third or developing countries, they really rely on inputs for their agricultural output. And you raise the input in, it's one thing for a farmer here in the US, but it's different for a guy in India or Bangladesh, right? And so, yes, I expect higher food prices for various reasons. And with, fuel equals food. I mean, if you raise the price of fuel, you have to mine phosphate rock and potash, right? So that requires diesel. To transport it requires diesel. To distribute it causes diesel. To apply it, diesel. So the price, these things are not thought about. They're just like, well, they'll just bring another mine on and it won't be a problem and all these problems will go away. So I think as we've, because of these, we've interrupted deliberately the supply chains like we have, that comes into play. So that kind of feeds into the second question here, how to play the ag market asymmetrically. Well, that's what I addressed in the last November issue of AIA, Actionable Intelligence. I didn't really have an asymmetrical way to play it. Your best way really is buy yourself a basket of fertilizer stocks. That's probably your best way. As far as juniors that we can go 5 to 10, there's not that many around. There are a few. I'm looking at them, but I haven't. I've invested in throughout my career, farm technology. The equipment makers. You can look at that. But these things are not things that are going to go 10 bagger, right? So I think it's creating your own little ETF of fertilizer producers probably would do well. You'd do well there. There used to be a fertilizer ETF. It was called Soil, and they actually got rid of it in August of 2020 because there wasn't that much interest. That was an indicator of a bottom, by the way. When they get rid of the ETF because there's no interest, that's usually an indicator that the industry is bombed out and could be an opportunity. Conversely, when an industry explodes to the upside, a lot of times they'll bring ETFs on at the top of the market. So something to think about. So another input from a reader, he told me of the conversation he had with a subscriber with somebody that works in the oil services industry in Canada, and some of the issues that they're seeing there as far as turning oil services drilling and fracking and completion back on. And so these are some comments. I tell this side, getting the hands back on the rigs. So of course, here we go again. Labor is a huge issue. You have the younger guys who come in and quit on the first day or halfway through acceptance testing. Workers during the last layoff, he estimates that 50% of them will not return. Some of them have retired working at places like Home Depot. Others have moved on to install wind and other trades. He also mentioned that the people remaining are older and worried that they won't be able to pass on their knowledge. Yeah, I'm seeing the same thing in the industry I work in, construction. A lot of young guys, we have a lot of turnover. People don't have the same work ethic. They don't have the same ability to absorb the material, it seems. And so that's a problem. People don't like to travel either. They don't like to be away from home, living in an econo lodge or a man camp. If oil was trading at $150 a barrel and the companies just threw money at people to entice them to come back, how long would it take to get things back to the way they used to be? He said at least 1 year, probably closer to 2 to get things humming. If you do throw enough money out there, you'll get people to come back. But then again, you're running a business. You can't just afford to pay everybody, hundreds of thousands of dollars, or, at some point it's not, viable business. So there's checks and balances on that also. He also mentioned that a lot of the plants, name drop Syncrude, have been on a close to breakdown maintenance schedule for the last 5 years, and many of them are planning scheduled maintenance in the first half of next year. So that's another thing that happens, right? If you're in an industry that is in distress, like the oil industry was for the last few years, that's what you do, right? You don't go out and just go crazy. You just, do what you need to do to keep the thing running, to cut costs. And so at some point you have to start investing. You start have to doing more in-depth turnarounds and shutdowns to keep the plant running. I mean, these big plants, like when I worked in the refinery and these power plants, we don't run things to failure. We do things like predictive maintenance. We have different tools we can use and data that we gather that we can actually predict when a piece of equipment may fail. And then we can schedule it for maintenance during the turnaround, like anticipate a bearing failure or the various constituents of oil sampling that we do. We can see the metals in it. We can see different constituents of the oil will tell us what is happening with that machine or like a transformer. And that way we don't just, you're not going to run a plant like that or a power plant to failure. You're just not going to, that's just not how things are done in real life. But if you're struggling or you're cash constrained, sometimes you may have to do that. So then you have to come back, spend more money and time once the salad days return. So we saw this week. Kazatomprom signs term contracts with China. So this is a direct quote from the press release. During the expo, they had an expo, exporters expo or importers expo, China and Kazakhstan. Kazatomprom concluded 2 term contracts for the supply of natural uranium concentrates one with China National Uranium Limited, and a second with the State Nuclear Uranium Resources Development Company Limited. The quantities and specific contract terms cannot be disclosed due to confidentiality and commercial sensitivity. So was this 100 million pounds? Was it 10 million pounds? Was it 1 million pounds? We don't know. What was the price? We don't know. Does it have a floor price and escalators? We don't know. What we do know is that China is on the prowl for uranium resources to support their now announced 150 reactor build out over the next 14 years. Okay. And they're going to ensure that not only do they have enough uranium to start the reactors, but to run them, because you're not going to make a $500 billion investment and not have sufficient fuel supply. So, you know, do I have any inside information? No, but I suspect that the Chinese don't sit around and wait for a crisis. They plan things out as best they can. And if you know you're going to build this many reactors, you're going to go, I mean, Kazakhstan's basically next door to Western China. So this is part of the whole Shanghai Cooperation Organization. This plays into it. Geopolitics plays into this. And I think this is very bullish longer term. Why? Because a lot of utilities in the West are just sitting on their hands. People they're starting to wake up, but they haven't fully arisen from their slumber as it regards the supply constraints that are coming down the pipeline vis-a-vis uranium. And so, you know, I wanted to put this out. Like I said, I don't have any information beyond what this is. You can speculate, but, you know, I would suggest to you that, you know, China is probably going to be working with the Kazakhs to, you know, make them a premier supplier and a reliable supplier for their nuclear ambitions. So I want to throw this out there too. Meb Faber, I like reading his stuff. He's got a lot of free stuff on his website. And so the tweet here is US CAPE ratio currently at 40. What's the CAPE? The cyclically adjusted PE ratio. That was this is a tool to measure valuation relative to cycles, economic cycles. And so if you study this, and I've talked about this before, the higher that the CAPE goes, the lower your forward returns are. That's what we've seen from the historical information. So historical averages 5 and 10-year real returns year end when the CAPE is 40, above 40 across all countries equals negative. So what we're saying here is when you have, if your starting point, if you're out buying stocks today, like the S&P 500, at the current CAPE, you can expect your 5 and 10-year returns going forward to be negative. Now, I'm not talking like 20%. There's something like 1 or 2%. And how do you get there? Well, you'll have an up year of 10 or 15%, and then you'll have like a down year of 25%. So what typically happens when you have these extended CAPEs is you usually have, like I said, these small losses or small gains each year, and then you have a big drawdown somewhere in that 5 or 10-year period, 30, 40% drawdown. And that's what really cements in the negative 5 or 10-year return. And so what I thought was interesting is what he said here. This is why I like listening to this guy. A lot of people will write back to me and say, well, his ETFs suck. They don't return good. That's irrelevant. This information that they gathered is factual information. And so pay attention to this statement. I can't find a single instance in history where a country's stock market ended the year at above a 40 CAPE and met historical 10-year real returns of 6%. So in the history of all the countries, when their CAPE is above 40, the 10-year returns are not even 6% a year. And we showed a poll of investors, I think maybe a month or two ago, where the average investor is expecting 17% year per year returns. So the expectations are not matching with the facts. And so, yes, the market is up significantly this year, but we are overextended. And I've been saying this, the overall general market is in a bubble. We know that. And now we have, inflation coming in hot. We have the taper beginning. So the liquidity spigot is at least being talked about and beginning to be closed. Okay, that has what has fueled these bubbles. Okay, I'm not saying there's going to be a crash. I don't know what the market's going to do on a go forward basis. There's no way to know that. It's unknowable. But we can look at these historical precedents and take some view based on them. That doesn't mean they're 100% correct. But it does mean that ignoring this is to your financial peril. Now, people will write in the comments, and I'll go ahead and answer the question now. What does that mean for the stocks that we're invested in? Well, uranium stocks are stocks. Oil stocks are stocks. Copper stocks are stocks. If the stock market goes down 50%, most stocks, 95% of the stocks will go down, not necessarily 50%. Mostly the overvalued stocks will go down the most. And the quickest to recover will be the more value-oriented stocks. But do not be under the illusion that you will be able to hide out in these other stocks. What you should understand is that if we have a market dislocation, which I cannot predict and you cannot predict, that you will have your stocks go down, and the stocks in the portfolio and the Actionable Intelligence Alert will go down. So they'll, like I said, though, once they turn the liquidity spigot back on, they'll be the quickest to return or recover. But this is why you have to, be an active portfolio manager. Or your alternative is just to put 286 or, whatever removed from your paycheck every week and put into an S&P fund for the next 30 years and ignore it and ignore the ups and downs. We talked about that Charlie Munger quote. If you're not able to withstand a 50% decline in your stocks, then this is not the place for you. That's paraphrasing. You have to get your mind set around that. It doesn't mean you just sit there when it's an obvious market dislocation and ride it all the way down. Okay. People write me all the time and say, what should I do? Some of the stocks in the portfolio are up 600-700%. Well, it just depends on your individual circumstances. If somebody writes to me and says, well, one person wrote to me and said, I can now pay off my house and I now have financial security for my family. What should I do? Well, in those circumstances, if that's your goal, you should probably sell down sufficiently to pay your house off and have that peace of mind. You've met your goal. What's the point? To squeeze out the last 20, 30, 40% move? To risk, to put your financial well-being and your goal of paying off your house at risk? If that was your goal of why you were investing or speculating, you've reached your goal. Sell it down to do that, and now you have the peace of mind. If you're laying awake at night, oh, what should I do? I don't know what to do. I can't sleep. I'm drinking Pepto-Bismol and eating Tums. That you own too much stock and the wrong things. You should sell it down. That's my advice. Everybody's different. And the hardest thing to do is sell. It's not easy, but it's relatively more easy to find stocks to buy than it is to tell people when to sell. And so what I suggest you do, and what I've suggested many times before, and I'm going to reiterate this again for the 1,000th time, make an investment plan. Write it down what you're trying to do. Sit down in a quiet room. I'm not saying write a 40-page term paper, but write down what you're trying to achieve, what your risk tolerance is. Be honest with yourself. I'm going to try to achieve this, because you have to get these emotional and refer back to it. These emotional and psychological things are the biggest constraints to being successful in investing. FOMO, fear of missing out; greed, fear of missing out on losses; fear of missing out on gains; fear of losses; fear of failure; fear of what people are going to say. All these things. You have to take all this into account. You have to write it down, and you have to work on it. This takes work. You have to work on your emotional state of mind. You have to work on your plan when you're going to sell. It's not normal to have stocks go up 200 or 300% in 18 months. We've had some of those returns. I just told you that going on a go forward basis, you can expect to have 6% or less returns a year, or probably negative returns in the general stock market. And yet people are asking me, do you think things are going to go higher? I have no idea. The future is completely unknowable. I just go by historical precedent. So I'm not getting on you guys. I just get a little bit aggravated because, people want me to tell them what to do, and I cannot do that. I don't know you enough. And even if I did know you, I can't tell you what to do. Everything, this is an individual journey for each of us. I can give advice. I can give the benefit of my experience, what has worked for me. But, that's why I read a lot of famous investors also. But a lot of things that they do don't apply to me either, because I'm different than Warren Buffett or Paul Tudor Jones. I can take different things that are, general workable things, but I don't have the same temperament or the same risk tolerance or whatever. So I wanted to spend some time on that because we do have some really great gains. People are really doing well in a lot of these stocks and companies. There's not enough conversation about this. And when something's up 400 or 500% or even 100%, that's, in a relatively short period of time, that's an anomaly. That's not normal, guys. And so locking that in is not, and what happens is, get ready for it. You sell after you have these huge gains, and guess what? It goes up after that, and then you cannot think like that. You cannot. I mean, I told the story how I sold most of my Bitcoin back in 2017 when it ran up. Was it 2017, 18, whenever it ran up for that bubble to 20,000 originally? I sold most of my Bitcoin between 3,500 and 4,000 because I had bought it, at $100, $200. I was up, 10, 15 times. Then I subsequently watched it go parabolic to 20,000. I did, I was like, well, it happens, I mean, but you can't kick yourself because the returns they weren't necessarily life-changing, but for that year, I made my year for sure. So think long-term, think like a long-term baseball player, like, guy with a 20-year career, Rod Carew, Pete Rose, these guys hitting your singles and doubles, get you in the Hall of Fame. You don't have to just swing for the fences on everything. Be a Dave Kingman 3 outcome player. It's either a home run, strikeout, or a walk or a fly out. So you don't need to think like that. Think like the guy that's hitting singles and doubles. And if you strike out or you miss a pitch, then you just wait for the next pitch. Okay, so constantly opportunities are coming down the pipe. So don't fret. I wanted to point this out because I think it's kind of funny. Everybody's bagging on Russia all the time, but Russia is basically a resource-based economy. Not all the way; it's getting more technologically advanced. Obviously, you can see the performance of their military weaponry in Syria and other theaters. It's pretty good. But, the huge agricultural output, huge mining output in various minerals, obviously oil and gas. And so, yeah, I mean, I was talking about buying Russia a couple of years ago when it had a CAPE ratio of 5. 5 was it was one of the cheapest stocks or countries in the world. So I was recommending buying it, and here we are. It's been performing quite nicely since then. So that's another thing I do. I look at the PE ratios, the CAPE ratios of various countries, and then just buy the ETFs. That's worked out fairly well for us. If you've been watching my videos for the last couple of years, I've done the same thing in Egypt and Pakistan. We've clipped, 50, 40, 50% returns in a year, buying countries when they are, completely bombed out. Cyprus was another example a few years ago when they had the banking crisis. These places go through cycles too, political cycles. The human nature is people get ticked off, so they put in to power people, and people maybe wreck the economy or cause dislocations in the economy. The people get pissed off, and vote in a new bunch of people that vow to change it. And then, like I said, it's just another example of something going from terrible to less terrible. And you can, make a very nice living investing just in ETFs of countries that are going from terrible to less terrible. And so, Russia is a perfect example of that. And you can see, I didn't take the chart back, a couple of years, but for a while, Russia was severely underperforming the US. Now it's outperforming. So things are cyclical. That's why you have to, pay attention. You have to use different tools. And this is what leads to opportunity. And I just wanted to point this out. I suspect that as long as this decade, I would suggest to you that Russian stocks will probably outperform US stocks over this decade, over a 10-year period. Now, month to month, year to year, who knows? But when you tally it all up at the end, if we're going to be a decade of inflation and resource nationalization and resource price rises, I would suggest to you that Russia's better positioned than the US for that. So this is interesting. This got this off Frank Talk, U.S. Global Investors. They do a weekly SWOT analysis, and I pulled this chart off there. And so what you see here is, we had this. Here's this inflation. We had this big spike this week. The announcement, 6.2% of the official CPI. I mean, this is getting into 1970s territory now. You can see right before we had the last crash, we were up at this area with inflation before the housing bubble blew up. That's when oil prices were $150 a barrel, or 140. But what I wanted to point out is there's a guy named John Williams. He has a site called Shadow Stats. And what he does is he calculates the CPI based on the way they calculated it like back in the 70s, before they made all the adjustments to, the government. The government's crooked, right? It's full of humans, it's full of politicians, it's full of people trying to advance their interests. And so you have to understand is when you have these big CPI moves, this causes problems for the government because they have to do cost of living increases for like Social Security, veterans benefits, retirements, that kind of thing, federal employee pensions. And so they are self-interested and motivated. Remember, we've talked about this before, self-interest, okay? Motivation, okay? Incentives, good and bad. That's what motivates human beings. And so they're incentivized to minimize these CPI increases because, first of all, it shows the inherent inflation of the monetary system. Secondly, it forces the government to have all these COLA adjustments, which they can't afford, okay? And so that's why they are incentivized to minimize. It's just bad publicity, right? They don't want to have inflation or in prices, or price rises, because the population gets ticked off as they are now. And so what John Williams did is he calculates, that's why it's called Shadow Stats. He calculates the CPI based on the way that was calculated before they put all these fake adjustments in there to deliberately lower it. And what he's showing is not a 6.2%, but 14%. And this makes sense, right? Because you see these anecdotal articles. I saw an article in it was the New York Times, one of the papers this week during my readings. There was a pizza parlor guy in Staten Island, and he has over 200 items that he buys, ingredients, different things. And every single one of the ingredients for his pizzas, for his business, is up double digits. He was giving some examples. Garlic prices up 400%. I mean, just across the board, double digit at least. And so the government's talking about 6.2%. It's a lot higher. You can see it when you go to the grocery store. I mean, I went there yesterday. I'm just by myself living at my house, off for a week. And I went over and I loaded up, for the week. And I don't clip coupons or anything. I buy what I want, but it was, something that would probably cost me normally $100 was $180. Okay. And, you notice it. I noticed the prices, but, fortunately I'm blessed. I can pay, but I know that there's a lot of people on the margin that can't afford this. This is why people are so upset. And imagine, we've talked about this before. We talked about it earlier in the video. Food prices are going to lead to problems. You have the largest, we talked about it last week, the UN tracks this. Their food price index is at levels which in the past have triggered political crisis around the world, specifically in developing countries. This is where a large part of the risk is, because these people are spending a large portion of their income just on food. And if you don't have food, you are up a creek. That goes without saying. 3 days without a meal and you're going to have revolutions. That's just how it is. So we think inflation's understated. And I think that realization's setting in. Obviously, when you take the CPI even the official, and juxtapose it with current interest rates, you start pushing real interest rates substantially negative. You're in territory in real interest rates that are extremely negative like they were in the 70s. And why do I mention that? Because gold is waking up. I don't know if this is a GDXJ. This is the Gold Juniors ETF. We've seen, and right out of nowhere it came, right? The gold price has kind of got out of its band. It was 1760, 1770, 1780. It was just stuck in that range for a while. And now we've seen a move up to like 1850. And so obviously the gold stocks are responding to that. So this is a longer term chart that goes back to 2017. This is a weekly chart. This has been in a bull market. You saw the initial blast off after the after all the liquidity started. That's when we saw this 50-week line cross the 200-week line. The 200-week moving average is in a bullish ascendance. You have the 50-day above that, but what you saw is this big spike. It got overbought, and then it's worked off this overbought condition, went right down to the 200-week average, and has bounced off. So this is what you want to see. This is really technically correct. Now, am I suggesting we're going to have a run in gold stocks? I don't know. We have gold stocks in the portfolio. They've been getting ground down, but second to a uranium bull market, a gold bull market is very exciting. So I don't think we ever got out of the gold bull market. We just had a interim peak here. We worked off this overbought, and now we seem to have bounced. So if these gold prices hold or move higher, which some people are saying, is going to happen, you got to lows in sediment. Nobody was talking about gold or gold stocks. And that's where a lot of the focus should be. I was buying gold stocks over the last month or two. Okay. I buy things, people say, well, what should I be buying in the portfolio, John? And they're like, should we keep, is uranium a good buy here? Is oil? Why are you buying the things that are in the news? Yes, they're still good buys in the relative near term, probably, but they could be overbought. You need to, when you're cycling new capital into your portfolio, you need to be buying the things that where the sentiment is negative or low, and that has not performed that well. Okay, if you still have a long-term bullish picture, okay, that's where the opportunity is. Okay, we had the view that we were still in a gold bull market. I still think gold's going tremendously higher over this decade. I mean, Goring and Rosenzweig, who have done a lot of work on this, think gold's going to $10,000 an ounce this decade. I don't know. 3,000, 3,500 seems reasonable over the next 18 months to me, especially if this monetary situation continues the way it is with the inflation. I'm not going to get into too much into the macro. Suffice to say, I don't believe that the Federal Reserve and the central banks, at least in the West, can afford to have rates go up or stop the creation of money that they're doing. And it's with the debts we have. It's just that's a 4-hour conversation. Go to George Gammon's YouTube channel. He talks about it all the time. He's more versed in it than I am. So anyways, the point being that, on a weekly chart, your 200-day or 200-week is an ascendancy that's bullish. We came down, bounced right off it. Basically, that's what you want to see. If it would have broken through this, if we would have saw this 50-week continue lower and then puncture the 200-week, that would have been negative. But this overbought condition, and this has happened before. Several commentators, if you look at prior moves in gold, this is what happens. You have this big spike, a lot of activity in it. Sediment gets way overbought. It gets to record high sediment levels, and then you have a near-term peak, and then it takes a long time, a year, 18 months, 2 years to work off that overbought sediment and then get down into very low levels where nobody cares about it and nobody talks about it. And that's what's happened. So something to take into consideration if you're looking to put new money at work. But I think, I feel positive. Take a look at Caledonia Resources. That's another public company that I've talked about. It's a gold producer in Zimbabwe, very profitable. Blanket Mine is the name of the mine. Do some research on it. I'm not recommending you buy it. I'm just saying take a look at it. It's the public vehicle I like to talk about gold. They just picked up some more properties there. That's still probably the most underinvested, underexplored gold producing region in the world. Okay. And things are slowly but surely changing there. You have to respect the management that for the last 10 or 15 years was able to profitably mine gold, pay dividends in the economic conditions that that they encountered in Zimbabwe. So I think it's paying a pretty decent dividend. And it looks, the chart is similar to this chart. It seems to be bouncing. So something to, if you're interested, take a look at it. Take a look at the various ETFs like this if you're interested. Be aware, though, that investing in the gold junior space is fraught with a lot of pitfalls. I will just remind you of that. So here we talked about fertilizer prices, picked up this chart. This is from last week. This is the urea prices in New Orleans at the Gulf Coast spot price. You're at highs we haven't seen since 2008. You know, this is what we're talking about, right? This is the whole situation around natural gas and people shutting down production in Europe because of high gas prices. And these are worldwide markets, right? They're not just, there are some regional specific pricing, but you know, if you shut down production of these things, then prices, people are going to go scrounging around other places looking for supply. And so this is an interesting thing to point out. Now, these parabolic moves typically end badly, as you see, but we're in a different situation now. These were more because of, you know, small specific situations specific to the fertilizer market. This is more specific to the overall energy markets, the lockdowns, the pandemic response, and the ripple effects from that. So we don't know what this entails. We don't know how far, when this thing pulls back, where it settles at. Okay, we don't really know. So it's just something to keep in mind. All right, guys, that's it for this week. Kind of jumped around a little bit. It was kind of a Lollapalooza week of a lot of different information. I still feel pretty confident about what I'm seeing in the energy markets. We're kind of in that shoulder season. We're looking to see what happens over the next 2 weeks with the weather. If in fact these Atlantic oscillations, Pacific oscillation, the La Nina, if we start seeing these incursions of the jet stream pushing that cold Arctic air. One of the things I did notice, there were record low temperatures in the North Pole and in Antarctica. So if you get these jet streams pushing, where they get pushed down into the North America and Europe, you're going to have some extremely cold weather pushing down. So that's what we're looking for. You're looking at the forward forecast for a lot of the natural gas consuming regions of North America. So we expect to see that. We suspect that the overall winter is going to be colder than normal. And so we're maintaining our bullish stance on energy. So we'll see. All right, guys, that's it for this week. We appreciate the support. We appreciate the comments and the interaction, and have a good week. We'll talk to you next time.